Bitcoin has become an escape hatch for the high IQ financial elite. We know that Bitcoin has been very volatile lately, so what happens when people succumb to that volatility and they sell their coins? The people with long time horizons scoop them up. You see, when a monetary system becomes a bit unstable, the highest skill participants do two things faster than everyone else. Number one, they correctly identify the problem, and then they move into assets that keep purchasing power without asking permission. This advantage comes from information processing, incentives, and time horizon, not vibes. Start from first principles. Money has three jobs: to store value, to move value, and to measure value. And in a high debt environment, governments and central banks lean on policies that reduce the real value of their liabilities. That usually means persistent currency dilution, negative real yields, inflation, etc. You can call it necessity, but the outcome is constant. Holding cash becomes a guaranteed loss in purchasing power over long periods of time. So this escape hatch is any asset that lets you exit that guaranteed loss. Historically, scarce assets have always filled that role because scarcity limits dilution. The problem has always been access, custody, and portability. Many people knew that gold mattered, but they could not store it safely, move it easily, or buy it efficiently when confidence was collapsing. Institutions and connected investors had those advantages, so they accumulated earlier and in larger size. Bitcoin changes that transport layer of capital. It gives global settlements, fixed supply rules, and self-custody as an option, and that combination matters because it lowers the friction of leaving the currency system. When the friction drops, whoever had the highest confidence and the best process moves first. Now, you might be asking, Adam, why high IQ specifically? Why are you using this phrase? I'm not saying that cognitive ability is some moral virtue here. I'm talking about pattern recognition under uncertainty. It shows up as lower impulsive decision-making, better probability judgment, and the ability to sit through volatility without confusing drawdowns for permanent loss. We have to understand that retail is often fodder for the institutions because the high-skill capital allocators that are out there, they also have structural advantages. They get earlier regulatory clarity, they get earlier access to custody, tighter spreads, professional execution through funds, desks, ETFs. They can size positions in a way that survives stress. Now, we know that the majority of Bitcoin is held by individual wallets, but the institutions are coming and they are coming fast. And I think the public response is lagging because Bitcoin is demanding. It requires learning. It looks volatile after a 30% drawdown. It gets attacked culturally. You can just be on Twitter. You see the negative sentiment right now. It's absolutely terrible because a lot of people don't understand the asset. But all of that skepticism about Bitcoin, whether you're hearing it from the quantum FUD people or anything else, in that window though, that window of skepticism, accumulation continues to happen quietly through the channels that don't look like retail frenzy. And over time, the supply of Bitcoin is going to migrate toward the most patient and best informed holders, because Bitcoin's supply is fixed and the market continually transfers coins from the weak hands to the strong hands during drawdowns. I'm going to lay out this mechanism very clearly. I'm going to look at the historical pattern of scarce asset accumulation during monetary stress, the psychology and incentives that make sophisticated buyers move early, and the real-world data showing where Bitcoin is concentrating today, including the ETFs, corporate treasuries, and the long-term holders. The goal today is very simple. I want to explain why this is happening, why it continues to happen, why this is just part of human nature, and what that means for anyone who is still deciding whether to treat Bitcoin as a trade or strategic savings over long periods of time. There's also a historical precedent with this entire thing. Let's go back to 1933 and talk about the gold confiscation that happened in the United States. In 1933, Executive Order 6102 forced U.S. citizens to sell their gold at $20.67 an ounce. You have to understand, in 1933, the United States was facing a debt deflation crisis. The banking system was totally unstable. Confidence in the currency was very fragile. and policymakers needed a way to reflate the system without explicitly defaulting. Gold was central to that system because it constrained monetary flexibility. Removing that constraint for them was not optional. It was very necessary from the government's perspective, and that's why they did it. This price of $20.67 an ounce wasn't some market discovery. It was purely an administrative decision. What matters is what happens next, though. Within months, the Treasury revalued gold to $35 per ounce. That was a deliberate monetary reset that transferred purchasing power away from the public and toward the institutions and the actors who either retain gold legally or position themselves ahead of this policy shift. And the key point is not about the confiscation of gold itself. The key point is the sequencing and how this happened. Accumulation occurred during uncertainty, policy then followed, and then the repricing locked in the gains to whoever owned gold. So all of the banks, any foreign governments, the connected insiders, they understood the direction of travel earlier than the general public did. They recognized that a monetary reset required a higher gold price, and then they positioned accordingly. By the time that policy became visible and totally unavoidable, the outcome was already decided. This is how elite wealth transfer actually works. It is not loud. It does not rely on any public enthusiasm. It happens quietly through foresight, access, and patience. The public usually encounters the change only after the window for optimal positioning has closed. So I look to this situation just to look at this pattern. Scarce assets are accumulated when they are politically inconvenient, publicly controversial, or poorly understood, and Bitcoin, in my opinion, still meets at least two of those three criteria. Once legitimacy, though, arrives through regulation or policy clarity, kind of what we're living through right now with Bitcoin, the price will adjust to reflect the new reality because it's becoming accepted as an asset, but we're still seeing retail getting scared out of their position. The gains will always accrue to those who acted before permission was granted. A lot of people like to jump in with FOMO after the run-up. And the relevance to Bitcoin should be obvious to you. We know that Bitcoin today kind of sits in that same pre-legitimization phase. We know that the institutions are accumulating like crazy with the Bitcoin treasury companies, the ETFs, and there are a lot of people buying Bitcoin in huge numbers that do not require this public narrative alignment. Retail skepticism continues to persist, but Michael Saylor keeps buying 10,000 Bitcoin per week. Regulatory clarity is emerging right now. It's not finished yet, so the asset is still treated as optional rather than foundational, even though the bricks are being laid. Now, I want to address a question that does get avoided because it is uncomfortable, but it is well studied. There is a consistent empirical relationship between cognitive ability and long-term wealth accumulation. The first point I want to make is methodological. These are not small or anecdotal studies. These are large longitudinal data sets that follow people over decades, and they control for education, income, and family background. What they isolate is not privilege alone, but decision quality over time. If you start with the German SOEP study, it shows that a 1 standard deviation increase in fluid intelligence corresponds to roughly a 1/4 standard deviation in increased household net worth. That relationship holds even after controlling for years of schooling and income, and the implication is that intelligence does not simply raise earnings. It changes how money is managed, saved, and invested once earned. The UK Wealth and Assets Survey was another one. It actually sharpens my points because it looked at stock ownership and that it does not scale linearly with income, which is very interesting. It actually scales with cognitive ability. Participation jumps from roughly 12% in the lowest cognitive decile to over 40% in the highest. That means that intelligence predicts access to compounding assets, not just cash flow, and this is critical because wealth comes from ownership and not from wages. And the British cohort study is pretty interesting. It extends the timeline a little bit. Individuals in the top quartile of cognitive scores are significantly more likely to reach the top wealth quintile by midlife. And this is not about early luck. It is about the cumulative advantage that these people have. Small decision edges over the course of their life Applied consistently over decades, these produce very large outcome gaps. And the mechanisms at the bottom here, they explain why this relationship exists. You have lower time discounting, better ability to delay your gratification and invest for long-term gains. You have better assessment of the risks that are out there, so you have better risk calibration. You have more financial literacy, so you have a superior understanding of all these complex financial instruments and opportunities. We know that Bitcoin is very hard to understand for some people. Well, not to the high IQ people that are out there. And we know that these people have better information processing speed and accuracy, and they allow for earlier recognition of structural shifts. That does not mean perfect foresight. It means reacting sooner when incentives change. And put together, this produces a very simple but powerful result. The high cognitive ability individuals are not just earning more money, they are systematically allocating capital into assets that compound over long periods that dominates all other factors. This matters for Bitcoin because Bitcoin strongly rewards these same traits. Bitcoin is volatile. Bitcoin is misunderstood. Bitcoin is very demanding. It requires patience, conviction, and the ability to ignore noise in the marketplace. And assets with those characteristics, they tend to concentrate in the hands of actors who can tolerate uncertainty and think probabilistically. So I'm not making some moral claim here at all. I'm just making a structural one. When a new, scarce, high volatility asset emerges, ownership will concentrate first among those who understand it the best. That shouldn't be controversial. We know that Bitcoin has a fixed supply of 21 million coins. That constraint is absolute. What changes over time, though, is who controls the supply and under what conditions it was acquired. As of December 15th, 2025, US spot Bitcoin ETFs collectively hold about 1.31 million Bitcoin. Public companies make up another 1.03 million coins, and the total tracked entities is about 3.75 million. So this is consolidated inside institutional structures. I'm not talking about any future speculation. If you look at the trend of the Bitcoin changing of the hands this year, individuals are selling like crazy and it is being scooped up by the institutions. So this is the present tense ownership. This isn't based on any future guesses. If we look at the asymmetry under these headline numbers here, when you look at BlackRock, IBIT alone manages about $73 billion worth of Bitcoin exposure. And at the same time, there are now only 950,000 addresses globally that hold one Bitcoin or more. That is the amount of whole coiners that are out there, which is less than 0.2% of all Bitcoin addresses, which tells us something very important. Scarcity is no longer theoretical, kids. It's already showing up in the ownership concentration. Now, this is the important part that I really want you to kind of internalize here. We need to think of the direction of travel of Bitcoin accumulation, because we know that the ETFs and the corporate treasuries, they acquire Bitcoin through regulated capital efficient channels. They buy during drawdowns. They buy the top. They rebalance during any retail panic. They are structurally designed to accumulate without emotional decision-making. So when we look at retail participation, by contrast, well, that remains very cyclical and reactive, which then creates a one-way flow of supply. Volatility transfers coins from short horizon holders to long horizon holders. Because the supply is fixed, every transfer reduces the available float for future buyers. And this is where my escape hatch framing becomes concrete. Because the institutions, they're not buying Bitcoin as some trade. They are buying it as a balance sheet asset that sits outside of the currency debasement risk. The ETFs aren't about speculation on Bitcoin. They are about making Bitcoin compatible with existing capital pipelines, pensions, endowments, and large pools of managed wealth. And very importantly, this accumulation is happening before full cultural normalization. Bitcoin is still publicly framed as risky, controversial, or optional. And this is exactly the phase where institutional accumulation historically accelerates, because price still reflects uncertainty rather than inevitability. So my critical insight on this slide is this: institutional accumulation is compressing the distribution of future opportunity with the asset. As more Bitcoin continues to get locked into treasuries, funds, and long-term custody, and the halving happens in a few years where the miner supply gets cut in half, we are going to see the marginal buyer being forced to accept smaller allocations at higher prices. It has to happen. I'm not trying to give you a warning. I'm giving you a description of what is happening as we speak. Bitcoin ownership is concentrating in entities with long time horizons, regulatory access, and low sensitivity to any volatility. This is sticky capital, and that concentration is very measurable. It's accelerating very quickly, and it's very structurally difficult to reverse with all this regulatory clarity that's coming out. And I think understanding this distribution shift is very essential for understanding what Bitcoin really becomes from here. When we look at modern accumulation, let's look at our pattern because it happens in 4 different steps. First is quiet positioning amongst bad sentiment. Institutions will continue to accumulate through OTC desks, ETFs, corporate treasuries, while public attention remains skeptical. While the people are fighting on X about whether or not Bitcoin is a Ponzi scheme, the institutions will continue to buy. Low conviction in the narrative keeps prices below what long-term fundamentals of the asset will forever continue to justify. Second is a narrative divergence is what happens. We're having regulatory approval happening unlike it ever has in Bitcoin's history. We have an infrastructure build-out happening in parallel with continued public doubt. So in my opinion, the perception just lags reality right now. And that gap is creating an optimal condition for informed buyers, not people trying to trade it with leverage. And then third, because of this, you just get the retail capitulation. The sharp drawdowns, they trigger selling from short horizon holders. Then the coins move systematically into long-term wallets that are insensitive to volatility. These transfers are rarely reversed. And fourth is the scarcity flywheel activation. Bitcoin's fixed supply and permanently lost coins tighten available float each cycle. As the supply locks up, the future entry requires paying higher prices for smaller allocations. And together, these 4 steps, they really show how Bitcoin is transitioning from speculative asset to strategic reserve for the smart capital that is out there. This pattern is not unique when you can extrapolate it to all of the other assets throughout history, but the supply mechanics behind Bitcoin is kind of the wild card here. We've never seen this before. So when we talk about implications of all of this, we are looking at a widening wealth gap, even worse than wealth inequality even is right now. And because we know that the institutional share continues to rise, people keep buying Bitcoin while retail gets shaken out. These institutions, they're going to continue to buy through any drawdowns. They're going to rebalance without emotion, and they are going to hold better through volatility. As their share of the supply increases, the gap between the early accumulators and the late entrants widens automatically, and this is just the mathematical result of fixed supply meeting unequal access and timing. And we're seeing that the policy tailwinds are arriving late by design. Favorable accounting treatment, regulatory clarity, and institutional legitimacy do not lead accumulation. Really, they follow it. This is consistent across monetary history. Risk is removed only after the sophisticated actors have already positioned. And then once policy support is very visible, price doesn't really reflect uncertainty anymore. It starts to reflect adoption. And then, unfortunately, we will see retail positioning continue to become more fractional. As the price rises and the supply continues to lock up from institutions who will never sell their Bitcoin, the late participants are just forced mathematically into smaller allocations at much higher entry points. This isn't exclusion by rule, it's literally just exclusion by the price. The gold revaluation after 1934 worked the exact same way. Ownership remained possible, sure, but meaningful accumulation was no longer accessible to the average participant. And taken together, these dynamics really explain why the wealth gap as it relates to Bitcoin will expand rather than stabilize. So what is the main takeaway here? Well, let's get into it. It should be obvious to you that if you're an individual holder of Bitcoin, you should probably continue to buy and hold Bitcoin. This is literally a description of how scarce assets will behave once they're absorbed by institutional balance sheets. Bitcoin is following that path with unusual speed and transparency, and understanding this slide is understanding the end state of Bitcoin accumulation. And if you're watching this thinking that you want exposure before this shift happens, now is the time to do it the right way. The Swan Private team works with high net worth families, individuals, and companies who wants to build generational Bitcoin positions safely, securely, and strategically. If you want to be on the winning team, the people who hold Bitcoin through the macro forces driving this transition, and how to own real Bitcoin, not paper IOUs, we can help you, because the goal isn't to trade the next crash, it is to survive and thrive through all of them. Visit swan.com/no-second-best to learn more. My name is Adam Livingston. I am the Bitcoin Wizard. I hope you enjoyed this transmission from Swan. Please like this video and subscribe to the channel. We bring you daily Bitcoin insights during the greatest wealth transfer in the history of humanity, and we want you here with us every single step of the way. Have a terrific day. Do not party too hard. Class dismissed.